Hey guys, in this video I wanted to go ahead and kind of walk through the logic behind the adjustments we make to net income for changes in current asset and current liability accounts when we are solving for cash from operations using the indirect method. I think it makes it a little bit easier to walk through that portion of the question. And per usual, at least how I like to do this is to, of course, demonstrate with an example. So let's go ahead and do that. So in this example, let's go ahead and let's assume our first year of operations. That's going to mean everything is starting with a beginning balance of 0. And let's say for simplicity that there was only one transaction that happened this year. And that's going to be that we earned service revenue of $100 by providing some type of service. And our client paid us $90 of cash. But they said, hey, I need a little bit more time. I'm going to pay you $10 in the future. So we put that on an accounts receivable. Now, when we're solving for cash from operations using the indirect method, our very first baseline assumption is that our net income equals our cash flows. And we make this assumption even though we know it's not true, so that we can have some type of starting point to begin with. And since we know that's not true, we're going to go ahead and back out any non-cash items that relate to those revenue and expense calculations. So going ahead and moving forward and looking at our example, what we know is that net income equals revenues minus our expenses, right? That's pretty straightforward. And in this case, we had $100 of revenue, no expenses, so our overall net income, our starting point, is that $100 value. And we, for starting purposes, pretend this is our cash flow. And now, since we know that that's not really our cash flow, the next step is to back out non-cash items that impact revenue and expenses. And to do that, we're going to be looking at current asset and current liability accounts, excluding cash. Now, in this example, the only type of account like that we have changing is our accounts receivable, and it changes by 10. And so since it changes by 10, we ask ourselves, well, what does that mean? And we kind of wrote out the journal entry so that we can see what it means. But basically, of that $100 revenue that we earned, that increase in our accounts receivable means that we didn't actually receive all of that revenue with cash. And this increase of 10 is stating that of that 100, we didn't actually receive 10 of it with cash. And so we need to back that amount out, which is what we do in the adjustment. So again, we're starting with that 100 and saying, let's pretend this is our cash flow, but we know $10 increase in our accounts receivable meant that 10 of that wasn't actually received in cash, and so we're backing out that non-cash item that's impacting our revenue and expenses to solve for a $90 cash flow. And you'll notice that this 90 matches the debit to cash for 90 that was in that single transaction over the year. And so using this information, we can prepare kind of like a little cheat sheet. So we know that if our current asset is increasing, as we demonstrated here with this accounts receivable example, we'll subtract that increased change from our net income. And so we know that if current assets decreases, we would want to do the opposite and add it to our net income. And then since current liabilities behave in the opposite way as current assets, we would just kind of flip those, right? So if our current liability increases, we would add it, and if our current liability decreased, we would subtract it. And so kind of using this baseline of information, just creating that top line using accounts receivable as an example, you can fill out the rest of this, and that can be used as a little cheat sheet when you're kind of working through cash from operations using the indirect method, and hopefully logically talking it out will help you as well. I also wanted to look at an example when we had a current liability account changing and how the logic behind this type of account works as well. And so in this example, we have revenue of $1,000 and all of it was received in cash, i.e. there was no change in our accounts receivable account. And then we had rent expense of $100, but we only paid $50 in cash. So our cash flows summarized is that $1,000 cash inflow, and then we have the $50 cash outflow for a total change of $950 increase in cash. So this is the background of this question, but let's say we weren't given any of this information in orange. Let's say all that we were given was that our net income equaled $900. and that the only change in this should say current balance sheet account, the only change in a current balance sheet account was our rent payable, that the beginning balance was 30 and that the ending balance was 80. So over the period, it had an increase in 50. And let's just say that only the information in blue was given for this question. Just based off that information alone, you could solve for that $950 cash flow. So again, under the indirect method, we're saying that net income equals cash flows, even though we know that's not true. In this case, our net income, our starting point is 900. And then we're going to go ahead and back out our actual cash by accounting for those changes in our current asset or liability accounts. So again, we're starting with that 900, but we had a change in a current balance sheet account of an increase of 50, and this was an increase in 50 of a current liability, right? And so simply using the cheat sheet that we were able to create in the last question, we know that an increase in a current liability is something that we should add back to our net income to solve for cash flows, and it matches, which is great, right? But it's helpful to kind of think of the logic behind that too. And say, okay, sure, I'm adding this change, but why? And if you think about it, if my current liability, if my payable account increases, it's because I didn't actually pay out cash for that expense. My journal entry would be a debit to an expense account and then a credit to a payable. And so since I'm not actually paying out that $50 increase in my liability as cash towards that expense, I'm going to go ahead and add that back to my net income to solve for my cash flows. So hopefully it was helpful to kind of see both a current asset account and a current liability account change and why we're adding or subtracting those to net income. Remember that this was a fairly simplified example and that you're also going to be adding back depreciation expense, amortization expense, and losses, and then you'll be subtracting out gains because again, those are non-cash items and they're also not related to operations. I also want to note in this video, we only discussed how to solve for cash from operations, and you'll also have to deal with cash inflows and outflows related to investing and financing when you're looking at a cash flow statement problem in its entirety. So hopefully this video was helpful. Thanks for watching.